There's a state where the average home insurance premium hit $7,562 in 2026, the highest in America, where the condo market just shed $109 billion in a single month, where 12 of the 50 riskiest counties in the country sit within its borders, and where the marketing brochure still describes it as the perfect place to retire. The state is Florida, and it's not even the first one to fall. While everyone's been arguing about whether there's a housing crash coming, the structural cracks have already appeared in specific states, not everywhere, in places with very specific vulnerabilities. And when the broader market tips, those states will tip first, faster, and harder than the rest of the country. According to Adams' Q1 2026 Housing Impact Report, foreclosure filings rose 32% year-over-year nationally, with foreclosure starts in the top 5 states reaching levels not seen in over a decade. According to the Federal Reserve, mortgage payments now consume over 30% of median household income, compared to 21% pre-pandemic. According to Zillow Home Value Index data, home values are declining year-over-year in 27 of the 50 states, with the steepest losses concentrated in the Sun Belt and Mountain West. According to Insurance.com and Insurify analysis, home insurance premiums in the most vulnerable states have climbed 50 to 90% since 2022, separating household budgets from local wage growth. And the structural conditions in 10 American states have produced a uniquely dangerous combination of overbuilding, insurance market disruption, climate-driven cost compression, and migration reversal. In this countdown, we're exposing 10 states that will collapse first when the housing market crashes. One state saw foreclosure filings climb 94% year-over-year in a single month. Another has 12 counties on the Adams Riskiest 50 list. A third saw single-family home values drop 6.8% in a year, the steepest statewide decline in America. A fourth carries the highest absolute foreclosure starts in America, while telling residents the market is healthy. A fifth is the textbook example of pandemic-era overpricing meeting buyer pool collapse. Subscribe before your state's market data updates. Like the video if you've watched a development go up next to your house in 2022 and watched the for sale signs go up in 2026. Let's break it down. Number 10. Utah, the Mountain West. Darling that sold itself as the responsible Colorado right up until the math stopped working. There's a state where home prices climbed at one of the fastest rates in America from 2020 through 2022. Where the affordability ratio now requires roughly 5 years of median household income, where the tech sector hiring slowdown has reached the Wasatch Front, and where inventory has expanded faster than the buyer pool can absorb. Welcome to Utah. The numbers. Utah home values flattened and began ticking down in 2025 per Zillow data. Utah was one of the fastest appreciating states from 2020 through 2022, with median prices climbing 45% in 2 years. Utah's affordability ratio now requires 5 years of median household income to buy a typical home. Utah's net domestic migration has slowed sharply from its peak per census vintage 2025. Utah single-family permits dropped 22% in 2025 as builders responded to soft buyer demand. What it's like. Living in Utah's housing market is like dating someone who peaked in 2021 and keeps bringing it up at every dinner. Picture this. You're a 38-year-old in Salt Lake City in 2026. Your mortgage was approved at 3.1% in 2021. The neighbors who bought in 2023 paid 30% more. Your equity looks fine on paper. Theirs is wobbling. The for sale signs in your neighborhood are staying up longer. Where it gets uncomfortable. Utah's structural problem is that the boom priced out the local buyer and the out-of-state buyer has stopped showing up at the volume spec builders assumed. The new construction is finishing. The buyers are not arriving. The tech employers that fueled the demand have shifted to slower hiring and selective layoffs. Sharp contrast. Utah and Idaho both rode the Mountain West migration wave. Idaho corrected harder and earlier. Utah is correcting later and quieter, but the math is similar. Same region, same hangover, different timing. Utah will look fine in early reports and noticeably worse by mid-2026 as the inventory backlog clears the spring buying season. Number 9. Indiana, the Hoosier state that nobody had on their housing crash bingo card, where the foreclosure rate just topped the national list. There's a state where 1 in every 739 housing units filed for foreclosure in Q1 2026, the highest foreclosure rate in America, where the manufacturing-anchored economy faces continued restructuring pressure, and where the affordability that defined the state in 2021 has been narrowed by climbing carrying costs. Welcome to Indiana. The numbers. Indiana had the highest foreclosure rate in America in Q1 2026 at 1 in every 739 housing units per atom. Indiana median home prices climbed approximately 35% between 2020 and 2024. Indiana FHA delinquencies have followed the national trend higher in 2025 and into 2026. Indiana manufacturing employment continues to face restructuring pressure. Indiana median household income has not climbed at the pace home values did, compressing affordability. What it's like. Living in Indiana is like dating someone reliable and sincere who just maxed out 3 credit cards you didn't know about. Picture this. You're a 41-year-old in suburban Indianapolis in 2026. Your home value is up. Your property tax is up faster. Your neighbor 2 houses down lost their job at the auto-adjacent plant in 2024. The foreclosure notice followed in fall 2026. The next neighbor sold their house at $15,000 below the previous comparable sale on the block. You're starting to read the local property records, where it gets uncomfortable. Indiana's structural problem is that price appreciation outpaced wage growth, and buyers who absorbed higher prices are now struggling with carrying costs. The home values have not crashed yet. The foreclosure rate has crossed the national leader line. The two together is what early-stage collapse looks like. Sharp contrast. Indiana and Ohio are neighbors. Ohio's foreclosure rate has stayed lower per atom Q1 2026. Indiana just crossed the national top. Same region, very different early warning signals. Number 8. Montana. The Big Sky State, where home prices climbed 56% between 2020 and 2024, the highest percentage increase among states. There's a state where home values appreciated at an unprecedented rate during the migration boom, where median household income has not kept pace, where Bozeman home prices climbed past $700,000, and where inventory has been accumulating against a buyer pool that cannot absorb the price points. Welcome to Montana. The numbers. Montana, home prices climbed approximately 56% between 2020 and 2024, the highest percentage increase among states. Bozeman median home price climbed to over $700,000. Montana median household income sits around $66,000. Montana median time on market climbed past 78 days, second slowest in America. What it's like. Living in Montana is like dating someone gorgeous and dramatic who showed up wearing a price tag they couldn't afford. Picture this. You're a 47-year-old in Bozeman in 2026. You bought in 2018 for $310,000. The neighbors who bought in 2022 paid $620,000. The new construction next door is listed at $750,000 and has been on the market for 6 months. You're not worried. The neighbors who bought in 2022 are absolutely worried, where it gets uncomfortable. Montana's structural problem is the cleanest illustration of pandemic-era overpricing in America. The boom was substantial. The local wage structure did not keep pace. The migration that drove the boom has slowed. The sellers face buyers who cannot absorb the carrying costs at the price points the sellers need. The new construction completing in 2026 is being delivered into a market that has already softened. Sharp contrast. Montana and Wyoming are both Mountain West states. Wyoming has not had the same in-migration or cost increase. Montana absorbed both together, which means more distance to fall. Hey, before we get into the top 7, the housing crash indicators have been documented in ATTOM Q1 2026 data, in Zillow Home Value Index updates, and in Insurify carrier filings. If this list has been useful, hit subscribe because the next one is 10 American cities where the property tax bill just doubled, and you'll want to see if your city is on the list. Like the video if you've watched a development go up next to your house in 2022 and watched the for sale signs go up in 2026. Drop a comment if your home value just dropped or your insurance just spiked, or both. Real conversations happen in the comments, and I read them. Now let's keep going. Number 7. Colorado. The centennial state where the mountain dream got repriced, and the wildfire insurance handled the rest. There's a state where statewide home values are down roughly 2.4%, where Denver Metro is down approximately 4.3%, where wildfire risk has driven multiple insurance carriers to reduce coverage along the Front Range, and where the cumulative cost of staying has compressed faster than the cost of leaving. Welcome to Colorado. The numbers. Colorado home prices climbed approximately 38% between 2020 and 2025, then started cooling per Zillow. Colorado wildfire insurance carriers have reduced coverage in multiple counties since 2023. Colorado net domestic migration has dropped from significant gains to roughly flat in 2025. Colorado property tax assessments have climbed across the Front Range as reassessment cycles caught up. Colorado tech sector employment growth slowed substantially in 2025 as Denver-based companies announced layoffs. What it's like. Living in Colorado is like dating someone outdoorsy and gorgeous whose monthly expenses you didn't understand until you moved in. Picture this. You're a 44-year-old in Boulder in 2026. Your home value is steady but no longer climbing. Your insurance premium went up 28% in 2025 and another 22% in 2026. Your property tax assessment came in higher than expected. Your spouse is doing the math on Phoenix. The carrier letter mentioned that future coverage was being evaluated based on regional risk profiles. Where it gets uncomfortable. Colorado's structural problem is the layered cost increase homeowners did not model. The home value plateaued. The insurance kept climbing. The property tax kept climbing. The carrying cost gap widened against a stable home value. Sharp contrast. Colorado and Utah are both Mountain West. Utah is cooling later. Colorado is already down with the insurance complication added on top. Same region, Colorado went first and harder. Number 6. Georgia. The Peach State where Hurricane Helene reminded everyone that inland and safe was a marketing slogan, not a fact. There's a state where foreclosure starts ranked 4th in America in Q1 2026, where Hurricane Helene caused $5.5 billion in damage in September 2024, where State Farm announced a 27% home insurance rate hike, and where Atlanta Metro spec building is now selling into a softer buyer pool. Welcome to Georgia. The numbers. Georgia had 4,356 foreclosure starts in Q1 2026, 4th most in America per ATTOM. Georgia absorbed Hurricane Helene's $5.5 billion in damage in September 2024. State Farm announced a 27% home insurance rate hike in summer 2024. Insurify projected 9% premium increases in 2025 and 10% in 2026. What it's like. Living in Georgia is like dating. Someone whose summers used to be predictable and now keep showing up with surprises that cost 5 figures. Picture this. You're a 42-year-old in suburban Atlanta in 2026. Your home value is up. Your insurance went up 27% in 2024 and another 9% in 2025. Your monthly carrying cost is $400 higher than 18 months ago. You're starting to look elsewhere for the math. The for sale signs on your block are sitting longer than they did in 2023. Where it gets uncomfortable. Georgia's structural problem is the combination of climate disruption, insurance repricing, and migration reversal hitting household budgets at the same time. The insurance carriers are repricing. The buyers are hesitating. The builders kept building until 2024. The Helene damage exposed inland climate risk carriers had not priced. The post-Helene reassessment of inland flood exposure produced premium increases that hit households after they had already absorbed the immediate damage costs. Sharp contrast. Georgia and North Carolina both absorbed Helene. North Carolina has held property values better. Georgia is showing earlier and clearer stress. Number 5. Nevada, the silver state where Las Vegas 2025 home sales hit their lowest level since 2007, and where the no-state income tax appeal has been offset by housing correction. There's a state where the tourism-dependent economy has been softening, where Vegas home prices climbed approximately 35% between 2020 and 2024 before correcting, and where the hospitality workforce that traditionally provided supplemental income has been less consistently available. Welcome to Nevada. The numbers. Nevada home prices climbed approximately 35% between 2020 and 2024, then softened in 2025. Las Vegas 2025 home sales hit their lowest level since 2007 per Las Vegas Realtors. Nevada unemployment rate climbed to roughly 5.7% in 2025, well above the national average. Nevada has lost residents to Idaho, Arizona, and Texas in 2025. What it's like. Living in Nevada is like dating someone in hospitality who keeps insisting next quarter will be great while their hours keep getting cut. Picture this. You're a 51-year-old in Henderson in 2026. Your home value climbed in 2021 and 2022. Your home value softened in 2024 and 2025. Your tourism-adjacent job has been less predictable for 2 years. Your retirement plan is now under review. The for sale signs in your subdivision are sitting longer than they did during the boom. Where it gets uncomfortable. Nevada's structural problem is that tourism and hospitality do not insulate the state during a housing correction. The tourism revenue softens. The workforce loses hours. The home values lose support from local wage growth. The 2007-2010 cycle hit Nevada harder than any state, and the exposure has not been diversified out. The retirees who bought in 2020 and 2021 are now facing a market where home equity has reversed and supplemental income options have narrowed. Sharp contrast. Nevada and Arizona are Sunbelt neighbors. Arizona has more diversified employment than Nevada's tourism concentration. Nevada's correction risk is more exposed to economic volatility. Number 4. Idaho. The gem state where home prices peaked at 26.3% annual appreciation in May 2021 and foreclosure filings rose 94% year-over-year in October 2025. There's a state where the appreciation cycle peaked harder than almost anywhere, where the California migration that drove the boom has slowed substantially, where Boise home prices have collapsed in year-over-year growth from 26% to 1.1%, and where the foreclosure surge has begun, showing up faster than any other Mountain West state. Welcome to Idaho. The numbers. Idaho home appreciation peaked at 26.3% in May 2021 per construction coverage. Idaho year-over-year price growth collapsed to just 1.1% by January 2026. Idaho recorded 206 foreclosure filings in October 2025, up 94.34% year-over-year per Inigo. Idaho net domestic migration has remained positive but has slowed substantially from peak years. Reddit quote, Idaho is the state where the Californians stopped coming, the prices stopped climbing, and the foreclosure notices started showing up in counties that hadn't seen them in 15 years. What it's like. Living in Idaho is like dating someone who got famous overnight in 2021 and is figuring out what to do when the spotlight moved on. Picture this. You're a 38-year-old in Boise in 2026. You moved from California in 2021 and bought at $620,000. Your home value is around $640,000 now. Your neighbors who bought in 2022 are underwater on their down payments. The development behind your subdivision has been sitting half-built for 14 months. The community sentiment has shifted from, "we got out at the right time," to, "what happens if it stays like this?" Where it gets uncomfortable. Idaho's structural problem is the most documented Mountain West correction in 2025 and 2026. The California migration slowed. The home prices corrected. The foreclosure rate climbed substantially. The sellers at the peak now face consequences of the most extreme appreciation cycle. The communities that built around the assumption of continued in-migration are absorbing consequences in property values, school enrollment, and commercial vacancy. Sharp contrast. Idaho and Wyoming are both Mountain West. Wyoming has not had the same housing cost increase or correction. Idaho overpriced itself for a moment in 2021 and is absorbing the consequences in foreclosure data. Number 3. Texas. The Lone Star State, where foreclosure starts, just topped the national list at 10,617 in Q1 2026. There's a state where Austin home days on market reached 89.7 days, with average price drops of $23,833, where San Antonio crossed 100 days on market for the first time in over a decade, where 87% of Texas builders conducted layoffs in 2025 per John Burns, and where the boom that built modern suburban Texas is now testing whether demand can support what was built. Whether demand can support what was built. Welcome to Texas. The numbers. Texas had 10,617 foreclosure starts in Q1 2026, the most of any state per annum. Texas property taxes remain among the highest in America at roughly 1.74% effective. Texas builders conducted layoffs at 87% per John Burns survey, the highest in America. Austin home days on market reached 89.7 days in Q1 2026, with price drops of $23,833. Liberty County had a Q1 2026 foreclosure rate of 1 in every 55 homes, the highest single county in America. What it's like. Living in Texas is like dating someone who built a wall of new houses for buyers who quietly stopped coming. Picture this. You're a 41-year-old in suburban Austin in 2026. Your home was approved in 2021 at 3.2%. Your property tax bill arrived and consumed 3 weeks of your salary. Your insurance premium went up 38% over 2 years. Your neighbors 2 streets over are underwater on their 2022 purchase. The new development next to you has been on the market for 9 months. Your colleague at the office moved to Tennessee in early 2026, specifically to escape the property tax math. Where it gets uncomfortable. Texas's structural problem is that the no-income tax brand was real, but property tax, insurance, builder oversupply, and foreclosure concentration have reshaped the cost of living math. The builders responded to 2021 demand by building through 2024. The buyers ran out in 2023. The inventory has been working through ever since. The 87% builder layoff rate is the industry confirming what absorption data has signaled for 2 years. The pandemic-era migration that fueled the boom has fully normalized, with Texas no longer leading the nation in net in-migration. Sharp contrast. Texas and Tennessee are both no-income tax states. Tennessee has lower property taxes and lower home insurance. Same income tax structure, very different total cost of ownership. Number 2, Arizona, the Grand Canyon state, posting the single steepest statewide home value drop in America. There's a state where home values dropped 6.8% year over year in 2025, where Phoenix recorded over 70 days above 110 degrees in summer 2024, where the Colorado River water allocation continues to face structural pressure, and where the retirement migration brand has been disrupted by climate, water, and cost pressures arriving together. Welcome to Arizona. The numbers. Arizona home values dropped 6.8% year over year in 2025, the steepest statewide decline in America per Zillow. Phoenix recorded over 70 days above 110 degrees in summer 2024, the most on record. Arizona's Colorado River water allocation continues to face structural pressure with Tier 1 shortage maintained. Arizona's population growth has slowed substantially from its 2020-2022 peak. What it's like. Living in Arizona is like dating someone unbelievably sunny who keeps avoiding the conversation about the water bill and the air conditioning costs. Picture this. You're a 67-year-old retiree in Phoenix in 2026. You moved from Minnesota in 2021 for the affordability and warmth. Your home value has dropped roughly 7% since you bought. Your electric bill in July was $580. Your insurance went up 22% in 2 years. You're starting to research where the cooler retirees are heading next. The community center pool was closed for 2 weeks in August because of staff shortages, where it gets uncomfortable. Arizona's structural problem is the convergence of climate intensity, water uncertainty, and home value decline against a population that relocated specifically for affordability. The summers got longer. The water got scarcer. The home values dropped 6.8%. The structural pressure on the Colorado River reflects a multi-decade decline. Climate models do not project will reverse. Sharp contrast. Arizona and Nevada are Sunbelt neighbors. Nevada cooled too. Arizona's climate and water exposure dropped values harder than Nevada's tourism exposure. Number 1. Florida. The sunshine state that won the entire pandemic, then quietly led the entire country in home value losses, all while insisting everything was fine. There's a state where 12 of the 50 riskiest counties in America sit within its borders, where home values are down 5.1% year over year, where Florida lost $109 billion in total home value in a single month in 2025, where the average insurance premium hit $7,562 in 2026, and where the convergence of climate, condo, insurance, and migration pressures has produced the most documented state-level housing market deterioration in America. Welcome to Florida. The numbers. Florida home values are down 5.1% year over year per Zillow Home Value Index 2026. Florida lost an estimated $109 billion in total home value in a single month in 2025, the largest dollar drop of any state in America. Florida has 12 of the 50 riskiest counties in America per Adam Q1 2026. Florida average home insurance premium reached $7,562 in 2026, the highest in America per insurance.com. Florida had 10,099 foreclosure starts in Q1 2026, second most in America. Cape Coral Fort Myers led the nation with a 9% median price drop to $341,250 in Q1 2026. Reddit quote: Florida is the state where the insurance is a second mortgage, the condo assessments are a third mortgage, and the home value notification arrives every month with a number nobody wants to read. What it's like. Living in Florida is like dating someone who looked perfect on the brochure and turned out to have hurricane damage, structural deficiencies, and a credit card statement they didn't disclose. Picture this. You're a 71-year-old retiree in Pinellas County in 2026. You moved from Connecticut in 2018. Your insurance premium tripled between 2020 and 2025. Your HOA assessment after Hurricanes Helene and Milton was $14,000. Your home value is down 7% from 2022. Your daughter is researching North Carolina for you. You're not arguing. The condo association meetings have shifted from social events to fiscal emergencies, where it gets uncomfortable. Florida's structural problem is the full convergence of every major housing market risk factor in a single state. The climate is intensifying. The insurance carriers are exiting or repricing. The condo regulatory mandates are producing six-figure special assessments. The retirement migration model that built modern Florida is reversing. When the broader market tips, Florida is positioned to lead the country in absolute dollar losses again. The 2008 cycle hit Florida hard, but produced eventual recovery as climate and insurance pressures were not yet structural. The 2026 cycle is different because the underlying conditions do not reverse on the same timeline. Sharp contrast. Florida and North Carolina are both Southeast retirement destinations. North Carolina has absorbed Florida leaver migration in significant volume since 2024. Same Sunbelt orientation, very different post-2024 trajectories. So there it is. 10 states that will collapse first when the housing market crashes, on the public record, in ATTOM Q1 2026 data, in Zillow updates, in Insurance.com and Insurify filings, in John Burns surveys, in census migration data. States where pandemic-era overbuilding has not cleared. States where insurance carriers have exited or repriced. States where climate disruption has intensified faster than household budgets can absorb. States where migration reversal has thinned the buyer pool. States where foreclosure data has begun confirming what inventory data has been telegraphing for 2 years. The American states with resilient housing markets in 2026 share specific characteristics: stable insurance markets, limited overbuilding, diversified economies, and demographic patterns that retain working-age residents. The 10 states on this list have the opposite combinations. The boom borrowed demand from the future, and the future just sent the bill. The 2008 housing crisis hit. Specific markets, specifically. The 2026 cycle is shaping up to follow the same pattern, with geographic concentration of risk having shifted from the previous decade. The insurance bills will keep arriving. The property tax assessments will keep climbing. The HOA assessments will keep landing. The foreclosure notices will keep showing up in counties that did not see them in 2008. And the residents who can move will keep moving. If this list helped, share it with the friend who keeps insisting their state's housing market is bulletproof. Hit subscribe, because next we're breaking down 10 American cities where the property tax bill just doubled. Drop a comment if your home value just dropped, or your insurance just spiked, or both. And remember, the worst housing market crash isn't the loud one with the headlines. It's the quiet one, where a state loses $109 billion in a month, 12 of its counties land on the riskiest 50 list, and the marketing brochure still describes it as the perfect place to retire.